Hey, it's John from stopsaving.com and welcome to the next video in our course on Technical Analysis Simplified. Now, I've mentioned a few times in this video series that when it comes to indicators, it's all about quality over quantity. And if you had to choose just one indicator to help you become a better trader, I think it would be Bollinger Bands. That's because Bollinger Bands are what we call an all-rounder indicator. This course has 3 videos dedicated to Bollinger Bands, with this one being the introduction. So with that said, let's jump in. And here's what you'll learn as we go through this video. Number 1, why it's important to pay attention to volatility when trading and investing. 2, what are Bollinger Bands and how are they calculated? And finally, number 3, why Bollinger Bands are one of the only indicators you'll ever need. So before we actually get to Bollinger Bands, let's first understand what volatility is in asset prices and how it tends to work. So without getting too technical, volatility is simply how much an investment's price moves around. The more prices move around from one trading period to the next, the more volatile the investment. Now, asset prices tend to cycle between periods of low, normal, and high volatility. When volatility is very low, it's often followed by very high volatility. That's because when volatility is low, the price isn't moving much and neither buyers nor sellers are in control. And when that happens, it only takes a small catalyst to move the price out of that equilibrium. And when the price moves out of that equilibrium, that's when big moves can happen. While it's typically easier to predict when volatility will come back, it's a lot harder to predict which way the price will go, as an up or down, when that volatility does come back. Still, knowing that prices are likely to get volatile is extremely useful information for traders. After high volatility, the volatility tends to go down again, as investor emotions of either euphoria or fear cool off. Now, one man who really understands the importance of volatility in trading is this guy right here, John Bollinger. Bollinger invented Bollinger Bands in 1983 while he was working as chief market analyst for the Financial News Network. He also wrote a brilliant book on Bollinger Bands, which I've read myself and I think is well worth your time. In the book, Bollinger explains that he never had a name for the bands until a news presenter asked him in a live interview. His first response he could think of was Bollinger Bands. It's also worth noting that Bollinger was the first ever analyst to earn both the CFA, Chartered Financial Analyst, and CMT, Chartered Market Technician qualifications. As a CFA charter holder myself, I can tell you that the exams are not easy, and this guy has spent a lot of time trying to understand finance and investing. If you follow Bollinger on Twitter, you'll also know that he likes to trade Bitcoin because it's volatile. So, with that introduction out of the way, what exactly are Bollinger Bands? Well, as I mentioned before, Bollinger Bands are an all-round indicator. That's because the indicator can tell you a few things. Number 1, how volatile an asset is at any point. 2, if volatility is going up or down. 3, if the trend is getting stronger or weaker. 4, if an asset is overbought or oversold. And finally, number 5, if there's extreme price movement. On the image to the right-hand side, you'll notice 3 bands, a middle band and an upper and lower band. The middle band is the 20-period simple moving average. This shows the general trend of the investment. Then there are the upper and lower bands. These get wider or further away from the middle band when volatility increases, and they get narrower or closer to the middle band when volatility decreases. So let's now go over Bollinger Band maths in a bit more detail. As I mentioned before, there are three bands: the middle band, the upper band, and the lower band. The middle band is the 20 simple moving average, or SMA. The upper band is the 20 SMA plus 2 standard deviations of price movement. And the lower band is the 20 SMA minus 2 standard deviations of price movement. Now, unless you're already familiar with maths and statistics, you might be wondering what on earth are 2 standard deviations of price movement. So allow me to explain the concept of standard deviation first, and then we'll relate it to Bollinger Bands and price movement. Standard deviation, or sigma, measures how spread out numbers are in a dataset. So it helps us see if values are close to the average, which is a low standard deviation, or spread out over a wide range, which would be a high standard deviation. Take people's heights, for example. A group can have small variations from, let's say, 5'6" to 6 foot, or big variations from 4'10" to 6'8". And it's the same with percentage price moves for an investment. Low standard deviation means low volatility, i.e. the price moves around close to the average, and a high standard deviation means there's high volatility, as prices are spread out very widely. So if you've studied statistics at school or university before, you're probably familiar with something called a normal distribution. Well, if you take enough random people and line them up, their heights would follow what we call a normal distribution. Visually, this would look like a bell curve. The average height would be in the middle of the bell curve like this. And in a normal distribution, roughly 68% of the people would have a height that is within 1 standard deviation of that average, and they can be taller or shorter than the average height. And roughly 95% of the group would have a height that is within 2 standard deviations of the average. In other words, 5% would have a height that is not within 2 standard deviations of the average height, if the sample of people was following a normal distribution. And as more standard deviations are added, the percentage gets smaller and smaller. For example, 99% of the people would have a height within 3 standard deviations of the average height, meaning that just 1% would have heights that are outside of that range. So think of it this way. In an average sample of adults, there will be far fewer people that are below 4 feet or above 7 feet tall than there would be who are between 5 feet and 6 feet tall. That's because 4 feet and 7 feet would be more standard deviations away from the mean than 5 feet and 6 feet, which would be closer to the average height. So by now you're probably wondering, what does all this have to do with Bollinger Bands? Well, prices don't strictly follow a normal distribution because you can have extreme events once in a while that causes the price to move in extreme ways. Just think of what happened in 2020 in March in the COVID crash. But Bollinger Bands do use a similar concept. So here's a bell curve to show how prices typically deviate from the mean. And the mean here is the average in the middle, which is the 20-period simple moving average. Now, Bollinger studied price action across multiple markets over a 10-year period, and his research showed that about 89% of the time, the price was inside the Bollinger Bands, i.e. it was within 2 standard deviations above or below the middle band, which again is the 20-period simple moving average. So based on that study, the price only has extreme moves that are outside of the band about 11% of the time. Knowing this is useful information as a trader, and we'll cover this a bit more as we go through this video. So Let's now relate all this back to an actual price chart with Bollinger Bands, and here's the Bitcoin one-day chart. Now, because this is a one-day chart, the middle band in this case would be the 20-day simple moving average, which shows the general trend of the investment. Then there's the upper band, which represents 2 standard deviations of price movement above the middle band. And finally, the lower band, which is the 20-day simple moving average minus 2 standard deviations of price movement. Now, remember from the last slide, extreme moves occur about 11% of the time on average, and that would be when the price gets outside of the top or bottom band. I've circled a few examples of when this happened in teal. Recall that Bollinger Bands are a volatility indicator, and that investments tend to cycle from periods of low volatility to periods of high volatility. It's for this reason that many traders pay close attention when Bollinger Bands squeeze together. That's because it's a sign that volatility is very low, which is a warning that a big volatile move is usually just around the corner. So here's the first band squeeze on the Bitcoin one-day chart. After that, the price moved violently to the upside as volatility came roaring back. And here's another band squeeze. This time, the price went down first, then up, then down, before eventually going higher. Volatility came back for sure, but the direction of the price move was less clear. And here's band squeeze number 3. Again, a bigger price move followed shortly after this. For the most part, you can generally look at a chart with Bollinger Bands and get a good idea of how far apart or close together the bands are, i.e. whether the price is volatile or not. But to make things a bit easier and a bit more accurate, you could also use the Bollinger Band width indicator in green below. The closer this is to 0, the tighter the bands, and the less volatile the price. Then, as the bands get wider and price gets more volatile, the indicator's value goes up. So here's that first Bollinger Band squeeze on Bitcoin. Notice at this stage that the green line was quite close to 0 here, meaning volatility was very low. The same thing happens again on the second band squeeze. Also notice how the price went down first before going up as volatility expanded. This move down would have caused a lot of panic, which gave the big money the seller supply they would have needed to buy in and push the price higher instead. That's called a liquidity grab, or if you recall from earlier videos, a bear trap. Then there's the third band squeeze. Again, the green Bollinger Band width indicator was very close to 0 when this happened. Typically, the closer the indicator gets to 0, the bigger the move when volatility eventually returns. Earlier in this video, I said that the 20 simple moving average, the middle band, can tell you the general direction of an investment. But in very strong trends, the price can trade along the upper or lower band as volatility keeps on expanding. And here's an example of this on the Bitcoin 1-week chart. So back in early 2019, the weekly bands pinched together. Volatility then came roaring back as the price trended higher over the next few months. While that was happening, the price was closing weekly candles near the top Bollinger Band while the bands were getting wider. And this is exactly the type of thing you want to see in a very strong uptrend. The same thing happened in late 2020, early 2021. You had your band squeeze, followed by a stellar bull run as the Bitcoin price trended near the top band as volatility expanded. By walking the bands here, you would have stayed in that trade for a very long time without taking profits too early. Trades like this don't come around very often, so it's good to let your winners run when they do, and using Bollinger Bands can help with this. It's also why selling at the top band is not always a good strategy. Of course, just as you can walk the top band up, you can also walk the bottom band down. Here's the gold one-day chart, and you can see here there's a Bollinger Band squeeze with low volatility. The price then goes up as volatility expands, but this is a fake out move and it traps the late buyers who buy thinking the price will now have a big upside move because volatility is expanding. In other words, it's a bull trap. The price then moves to the bottom band and starts to close candles near the band while volatility is expanding and the bands are getting wider. A similar thing happened a few months later. There was a band squeeze, then volatility expansion, and continuation with the downtrend. So I hope this makes it clear why buying at the bottom band is not always a good idea. So that's the end of this video, and here are the key takeaways. Number 1, Bollinger Bands are an all-round indicator that can tell you how volatile an asset is at any point, if that volatility is going up or down, if the trend is getting stronger or weaker, if an asset is overbought or oversold, or if there's extreme price movement. 2, there are 3 Bollinger Bands. The middle band, which is the 20 simple moving average, the upper band, which is the 20 SMA plus 2 standard deviations of price movement, and the lower band, which is the 20 SMA minus 2 standard deviations of price movement. Wider bands mean there's more volatility. Narrower bands mean there's less volatility. 3. Roughly 89% of price movement is within the upper and lower bands, according to a study by John Bollinger. That means roughly 11% of price movement is outside of the bands. And finally, number 4, selling at the top band and buying at the bottom band is not always a good strategy, especially for trend traders. So that's the basic mechanics of Bollinger Bands. In the next 2 videos, you'll learn how to use Bollinger Bands effectively in your trading strategy by buying near the lows and selling near the highs. So thanks for watching, and I'll see you in the next video.